I think the innovation and adoption of tech is only going to get bigger and bigger and bigger.
Right.
Tech, in many ways, has become a necessity for all of us, right? If you see how we used to do banking, how we used to do transportation, order our meals, everything is dependent on tech today, right? Will the same set of companies, the Mag 7, exist 10, 15, 20 years down the line? I don't know. Some will, some may get disrupted. We have seen this, like when I started university, the first mobile phone I had was an Ericsson.
Oh, okay, yeah.
I don't know if your viewers have used Ericsson,
Yeah.
but Ericsson and Nokia were the two largest players, and they were going to revolutionize the world. Then came smartphones, and today it is dominated by Samsung and Apple. Same thing, AI is one of those generational shifts that we're going to see. There will be new businesses that come up, OpenAI, Anthropic. And so having exposure to tech makes sense, but I can't tell you for certainty whether the same set of companies will be there 10 years down the line.
So many people have told me that they are investing in tech stocks. Ride the AI wave, others have said. But with the Magnificent Seven growing more expensive, and with talk of the AI bubble bursting, is tech still such a good long-term investment? Hi, I'm Suen Tan, and you're listening to Head Start on Record, a show that gives you a head start in your personal finance, career, and life. In the studio with me today are our investment gurus, Subhra Chatterjee from DBS Bank and Mark Yeo from StashAway. So hi guys, it's so good to have you here today.
Thank you for having us.
Yeah, maybe we just start with, what are the tech stocks that you guys invest in? Or do you even invest in tech stocks, right? Maybe Mark, we start with you.
Yeah, so for myself, I gain my exposure in AI through a mutual fund. So I do rely on a fund manager that is able to kind of select stocks that really relate to the AI theme. But aside from just having a very intentional exposure to AI fund, I have my core investment holding, so S&P, which is fairly popular, that would have quite a big concentration in some of the tech and AI stocks as well. So it perhaps is a conviction on my end to add into that theme through a dedicated AI fund.
Okay, so you don't do individual stock picking?
Yeah, because I think I recognize the theme of AI, but it's very tough for me to really select the stocks. Of course, there are popular names, but I'm just being very honest with myself. One, do I have that expertise to really decide that this AI stock is worth the price? And do I have the resources also to kind of spend the time and the research capability to have a more informed decision? So then I kind of take the decision to use a fund manager that does the work for me.
Okay, that makes a lot of sense. Yeah. So Subhra, people told me you're DBS Mr. Tech. So
Yes.
Do you invest in tech stocks?
Yeah, I think the reality is there's no getting away from tech these days. Tech is such an integral part of the global growth story. It is also a very exciting part of the equity market story. So I do have exposure to tech as part of my overall portfolio. The way I approach it is I have a bit of US tech and a bit of Asian tech. With US tech and Asian tech, I try to capture the AI value chain, if you will. So I have a few of the Mag 7 names. You have Apple here.
Yes, yeah.
I have some of the semiconductor and chip
Chips,
companies.
yes.
And then I try to see what are the other areas that could potentially benefit from the investments that is going into AI infrastructure. So I try to have a bit of industrial power, utilities to sort of add on to the AI story. I do a mixture of single stocks because that is my day job.
Yeah.
I also have ETFs and I don't do funds. I primarily do it through ETFs and single stocks.
Okay, so since you do individual single stocks, right? What is your strategy when it comes to stock picking?
So stock picking, generally, I would have to have high conviction. As Mark said, you really need to put in the time. I'm in an advantageous position because my day job includes researching companies. So I am aware of the names that I would have. So, things like Microsoft, Google, Amazon. I mean, these are safe, good quality companies that I have. Areas where I don't have a specific view, I try to do it through an ETF. So in Asia, I have in the past have individual stocks. But at present, I think it's an easier way just to do an ETF because there are so many different companies out here.
Right. Okay. So would you say, like, for young investors especially, if you want to do individual stock picking, you need to really know the fundamentals of each stock and you need to follow like their story, right?
Absolutely. I think, when it comes to investment, you really need to be comfortable, A, with what your goals are, B, what you're investing in, and C, whether you have done the work, whether you understand what those companies are. If you don't have that, if you don't have the time, as Mark said, I would go with S&P 500. It is the easiest way to build up your portfolio and start your investment journey.
Okay. So my question is, do you check your individual tech stocks every day? Like, do you look at their performance?
So the ones which are volatile,
Yeah.
I would.
Okay.
It's human nature.
Yeah.
But generally, my co-holdings, I don't check every day. I try to ascribe a certain amount. So I try to do it in a systematic manner. So maybe every month or every quarter, I'll put a certain amount, irrespective of the stock price, into my co-holding. It's much easier to do it with S&P 500, irrespective of the index levels. With stocks, that is my day job. So I do track them on a daily basis. So I know what's happening. And if the investment case changes for whatever reason, I may decide to rebalance my portfolio.
Okay, so it does sound like we are all still investing in tech, right? And we know that there has been talk of an AI bubble for some time. So maybe you can explain, what is this AI bubble about?
Yeah, so typically the way I would describe a bubble is when asset prices get elevated and they are not supported by fundamentals like earnings and cash flows. And so there's a risk that you may see a crash. I think oftentimes the way people use the term bubble is just because share prices have gone up and they've gone up
Okay.
for 3,
Yeah.
4, 5 years like we are seeing currently.
Yes.
I don't necessarily agree that just because share prices have gone up, it translates into a bubble.
Yeah.
You have to see what has driven those share prices. If it is earnings-led, and I can give some examples. If you see the earnings that the tech companies in the US has been delivering, they've been consistently delivering for the last 6, 7 years, 20, 30% earnings growth. So if the share prices are giving you 20, 30% annual return, to me, that's not a bubble. But I think the impression people have is just because the share price has gone up, it's a bubble.
Okay. Because, Mark, people have said that it's not even if the bubble will burst, right? It's kind of like when it's going to burst. Like, what's your take on that then?
Yeah, I think I'll echo what Subhra says, because as long as the fundamental continue, there is no finite time for a bubble to burst, as long as it is quality-led, there's actual earnings. So probably it's also a good time to compare this to maybe past bubbles, right? And bubbles is always easy to see on hindsight, not in real time. So if we it's quite often compared to, the dot-com bubbles, right?
Yeah.
The 1990s. The difference then is companies at that time had valuations of 80, 90, 100 times. And that's really more of the denominator effect, right? It's not backed by earnings. So if you kind of
Right.
think of a PE ratio, a common valuation multiple, if you don't have that earnings growth, you will have very high multiple. Now, 80, 90, 100 times PE itself does not mean it's a bubble, but of course, the assumptions to justify that is insanely high, right? To kind of justify the price, you will need a really unsustainable earnings growth. And back then in the dot-com bubble, you have businesses that simply put their domain with .com and they pretty much got that
Right.
kind of valuations.
Okay. Yeah.
But what is different today is that actually, if you think about the more popular AI names like the semiconductors or even the kind of software that delivers the cloud to power AI, names that probably our audience are familiar with, the Googles, the Microsofts, they are very good quality businesses. They didn't just come into AI to ride the wave. Microsoft, Google, Alphabet, all these kind of stocks, they've been there for some time. They have an actual business value and they kind of pivot or at least focus on a larger AI demand. NVIDIA, of course, the most talked about name, is the most powerful chip needed to run a lot of computation. So there is a lot of value, and they are by no means cheap for those value investors that are just seeking cheap stocks, but they are able to back that. So you'll be surprised to hear that even today, the last forward PE of the Max 7 is actually quite modest at 25. Even at the high of 2021, 22, it's 30. But it's nowhere near the kind of dot-com bubble where there's very little value.
Just to add on to Mark's point, he's absolutely right. If you see the fundamentals of the companies today, and most of your viewers would be familiar with the Mag 7, but they may not be familiar with the Four Horsemen. So
Right,
back
okay,
in
yes.
back in the late 1990s,
Please explain, yeah.
early 2000, during the dot-com, we had the equivalent of the Mag 7 called the Four Horsemen. And the idea was that these companies, Microsoft, Cisco, Intel, and Qualcomm, will revolutionize the world of internet. And there was a lot of hope built onto it. At its peak, they were trading on a price to earnings multiple of 150,
Wow.
160 times.
Yeah.
Right now, we are nowhere near. Most of the Mag 7 companies, except Tesla, is trading at 25, 26 times price to earnings, right? And these guys are growing still at 20 to 30%. So if you ask me, I don't think there is a bubble across the board. There may be individual companies which has become bubblish, but not at the aggregate market level.
Right. Okay. Yeah, that's a really interesting answer, right? Because I think because of all the AI talk, people say that there are companies that are overvalued or over leveraged. Like, can you explain what that means as well, and whether that affects maybe, like you were saying, just a small minority of companies, or is it like a bigger proportion, right, such that it becomes a cause for concern?
Yeah, so certainly there are pockets where there may be frothiness in terms of valuation. I think oftentimes people just find it difficult to buy these companies because they have seen doubling of the share prices, right?
Yeah.
And so people think, oh, they're expensive relative to what I saw. But it's also important to understand that these companies' earnings have also doubled over that period.
Right.
So
Okay.
if you look back, so the way to look at stocks is not just price, but price relative to the earnings that these guys are generating. So there's a natural fear. I understand that it's human. But certainly we don't think that at the broad level, things are looking expensive. Also in the newspaper, you have heard, companies like Google, Meta, they're borrowing huge amounts of money. So in absolute terms, the quantum is large, $200, $300 billion. But if I just take a step back, and you look at the four largest companies in the US, their market capitalization, or the value that they have, is in excess of $15 trillion. They generate every year $1.5 to $2 trillion of revenue. They generate profit as a group, a couple of $100 billion. So if you take on borrowing of $300, $400 billion, it sounds large, but relative to the size of these companies, it's actually not that big.
Yeah, okay. I think that's a really good point, right? About not just looking at the share price, but the earnings as well, and the company's performance at this point in time. And speaking about that, we're definitely going to talk about the Mag 7, right? Maybe you can explain what is the Mag 7 and how are these companies then doing?
Yeah, the Mag 7 is a popular term on the kind of the seven biggest companies that have a strong AI tilt, but of course they are seen as magnificent in a sense that regardless of market regimes, because of their structural story, they are seen to be the darlings, the kind of very attractive stocks in whichever market, and hence the term Magnificent Seven. So today your Mag 7, the constituents may change slightly, but commonly it's your Teslas, your Microsoft, your Amazon,
Nvidia,
yes,
Meta,
correct.
and
yeah.
Apple.
Yeah. So these are the Magnificent Seven stocks, and of course there's a lot of excitement because their last 3-4 years, despite the kind of drawdown in 2022, they've rebounded, and it kind of reinforces the concept of magnificent in the first place, and hence the term Magnificent Seven.
Right. And I guess for a first-time, investor, I say, I want to go into tech, right? And it looks like everybody's talking about this Mag 7, so why not try that? But we know that it's not, like, the share price is not the most affordable at the moment if you're a young investor. Like, I think I checked yesterday, May 7, Apple was trading around like 289 USD, right? Not even SGD. So, Mark, if I'm a young investor, what's your take on buying the Mag 7 as like my first investment ever?
Yeah, I think the concept of affordability is maybe not the right framing, because you can always choose how many number of stocks. It is always relative to the size of your portfolio. So it's quite difficult to say I can't afford one stock of Microsoft, which is 289. So I think what they're really saying is, I'm afraid the price is too high.
Yeah.
And is it really worth, have I missed out the rally? Which of course I think both Subhra and myself have started off that just because a price have done well does not mean that we missed the boat. As long as the fundamentals and the earnings remain sound, investors should appropriately sized and gain exposure to such stocks rather than trying to buy at the lowest price possible, because there is the other risk that missing out, right? If investors actually try to time and try to wait for a big drawdown, one, that might not happen, and you have to consider the opportunity cost of that. And number two, the longer you wait, at some point, you end up feeling the kind of urge to buy even at a higher price, which defeats your initial purpose, right? When you want to. So ultimately, the way to solve this conundrum of should I wait till a drawdown happens and give myself a bit more security, or should I buy it at the price today, even if it's slightly expensive? The way I see it is more of number one, start with your own investment objective, because even if there is a strong structural reason to buy into AI, it's not really advisable to put 100% just because the price is attractive. There's always a need to put at least some allocation. Now, whether that's 10, 20, that's down to the advisor and that's down to your own financial circumstance. But you don't want to have such a binary call on gaining exposure, either zero or all in, or even borrow to buy stocks in the case of some US retail traders.
Yeah, exactly.
You don't want to do that. You want to have at least some participation in it and in a well-constructed portfolio.
Okay, right.
Actually, if affordability in terms of price point is the concern, I totally agree that that's not how you should look at investment. But if it is affordability, actually there are platforms, including at DBS, where you can buy fractionalized shares, where you don't have to buy a full share of Apple. You can buy a fraction of the share. And it will happen. More and more platforms will be offering that over time. Yeah. Personally, I also think, going back to S&P 500, if you just buy the index or through an ETF, that already gives you a 40% exposure to technology, because S&P 500 has 40% allocated towards tech.
Right, exactly. Yeah. So it's not just a case of saying, like Apple's 289 or Microsoft is 420 right now, and I kind of have missed it, right? Because I want to buy low and sell high, obviously, as everybody wants to. But it's a case of like really looking at what you need and also where your portfolio allocation is going, right?
That's just to add to that point, I think the beauty of this question, it's you don't need to be exactly right. That means you don't have to make such a binary bet. And often, as an advisor, I've always got the question, the question is always framed, should I go in now? Should I? As if it's a kind of all or nothing kind of question. When actually the obvious or a more structural answer is you don't need to make that call.
Right.
So the worst case, let's bring this to life a bit more. Let's say truly is a bubble, which of course that's another separate discussion. Whether it is a bubble is a separate discussion topic. But let's even assume that the valuations today are a lot more expensive, but AI is here to stay, right? To put a 10% allocation kind of gives you a nice weighted probability between, okay, even if the next 2 years there's going to be a kind of correction of 20%, because you size it at 10, the absolute exposure to your overall portfolio is 2%. It's something that clients are willing to, at least they won't feel like their life is destroyed because I put all my portfolio in AI. But at the same time, you're not missing out just because you're always waiting for the drawdown, which is a bit of like waiting for Godot that never comes, right?
That's a great example.
So it's so to solve this problem, it's always nice to add an allocation. But the assumption to doing something like that comes with the premise that in the very long run, there is still value. So it's a non-zero allocation. Now, the question then, whether it's 5, 10, 50, is down to the risk profile, the life constraints. But you don't need to make a binary question of, should I buy now? It's always a kind of exposure to a structural long team. And one way to diversify it is dollar cost averaging as well, right?
Yes,
You don't have to lock in your exposure all at one price today. You can always build a more regular investing plan, so you're kind of also diversifying your entry points. So you're also less worried about, even if I'm buying AI stocks at today's expensive price, even if it draws down, because I believe in the long-term theme of AI, I'm actually lowering my average cost and still maintaining the allocation as well.
Yeah, I mean, speaking of portfolio allocation, right, and diversifying your portfolio, we can also talk about some other companies that are still within, I guess, the general tech industry and sector, but they are not pure AI plays or not like the Mag 7, right? So Subhra, for example, if I want some exposure to US tech, what are some of the industries that I can look at?
Yeah, so that's a great point. I think oftentimes people think of technology just as the tech companies. But actually today's tech, if you see, the way I see it, with AI, there are 3 layers. The first layer is, of course, the infrastructure layer, and everyone talks about it, the data centers, semiconductors, which is used to build the computing power. But then you have to actually build the data centers. You got to power the data centers. So there is an energy stack that has to come into the equation as well. Because let's be honest, AI is quite energy intensive,
Yes, yeah.
right? So I would look at both the energy stack, what goes into the construction of these data centers, then so semiconductors and the big technology companies will be a part of it. Utilities, the guys that provide electricity, are also a part of it. There are things like modular nuclear reactors that everyone is talking about, because a lot of these large data centers, they're trying to create their own nuclear power plant to provide power to run the data centers, right? So these are all areas which I think offer attractive opportunities, but oftentimes people only focus on the tech, not the ancillary industries. And look, our view is that the build phase of AI, building the computing power, is going to last for at least another couple of years, right? After that build phase is done, then comes the monetization. Yes. How do you drive monetize? You have spent so much money, right? You need to drive revenues. And the monetization will involve application, which will involve some layer of software companies. There will also be new businesses that come up. So everyone has heard of OpenAI, Anthropic. Wouldn't surprise me if in the next 2 years you see them also being listed, and there'll be new business models that emerge. So that's why, sitting today, I may not know how the world will look 5 years out, but I know if I have exposure to tech more broadly, that will capture some of the new business opportunities that come in as well.
Yeah, it's so interesting that you even talk about utilities and energy companies, right? Because that's something maybe we don't think about straight away when we talk about tech and AI. But you're right. I mean, what will power the data centers, right? And I guess for Mark, on the Singapore side, because we hear a lot about young investors saying, oh, I'm into the Nasdaq, I'm into S&P, I'm into Max 7 and US stocks. But on the Singapore side now, with this push for the SGX trying to revitalize our local stock market, how do young investors who want to get exposure to tech kind of play into that, right?
Yeah, it's a good question. Unfortunately, the Singapore index has its own structural limitations,
Yes,
right? So
yeah.
if, let's say, we look at the Straits Times index, unfortunately, the kind of tech exposure there is not as large as the kind of US and global. It's still very much heavy in financials and REITs. And perhaps you can argue that maybe some of the REITs may be a proxy play to AI. But even then, if you really look closely at some of the REITs underlying, it's not other than maybe one or two REITs that specialize on data centers. You're not really playing the data center AI. You're playing more residential and the traditional commercial
Right,
REITs.
yeah.
So unfortunately, if STI is the first port of call, unfortunately, it hasn't been a very tech-heavy, let alone AI-heavy.
I'm hoping the Nasdaq Singapore listing,
Yeah, the
and I
global
think they've
listing
announced
board,
global
yeah.
listing. I hope that drives more tech-focused companies coming in. At the moment, I'm not sure how it'll play out, but I think if it does, it's quite exciting for the Singapore market because, as Mark said, at the moment it's primarily banks and REITs, but I'm hoping in 5 years' time we will have more opportunities. I mean, a good example is Grab. Grab is listed in the US. It's a homegrown company, so that's the natural fit. Everyone knows of Grab in Singapore.
Yeah, but I think that's a really good point, right? The fact that right now, I guess the Singapore stock market is still quite traditional in that sense. Maybe we might even say conservative, but we never know, right? Like there are some new things on the horizon, and the global listing board is definitely one that's very interesting.
Yeah, maybe to add to your question, I would say for investors that are looking to invest in AI or tech beyond US, and do they want to look at Singapore because Singapore is a comfort market? I think the starting point for investors should be not to kind of constrain geographically, but to really objectively look at fundamentals. Now, if the output of that leads to a lot of allocation in US companies, that's natural because you're ultimately not making a bet on US equities. You're making a bet on the companies that deliver AI and they have that moat and they have the fundamentals to do that. And it could be the case that I won't be surprised it won't be entirely US tech. You could have Asian tech companies as well. So the semiconductor, you'll get a very big exposure in Asia. They're manufacturing in Korea, in Taiwan. You'll find some names there. You'll also find quite a few cloud providers at a kind of a discount compared to the Western cloud providers. So I wouldn't be surprised that if investors are kind of looking to get exposure, it won't be too US-centric. There will be quite exposure to US companies, they'll get some Asia companies, but investors should not try and start constraining themselves to, I want to find AI companies in Singapore or in Malaysia or in whatever geography. Focus on the business model and fundamentals.
Yeah, actually, the two innovation hubs is US and Asia, but they're developing in different manners, right? So in Asia, for example, this year alone, you have seen massive rise from the likes of Samsung and SK Hynix. So the Korean market has been on fire. Taiwan has also seen a massive move higher driven by TSMC.
Yeah.
So Korea and Taiwan historically has been plugged into the global tech value chain. But Hong Kong, China also, if you see the innovation that is taking place, especially in the consumer tech space, it's massive. I mean, many of these companies, I mean, we talk about the Mag 7, but we have, Tencent, Alibaba, they're equally big. It's just that the way they target the market is very different. So, and especially in the world that we live in, where there is a lot of geopolitical fragmentation, I think increasingly what we will see is a global ex-China story where it's largely the US companies, and then you've got a China-based ecosystem, China and Asia-based ecosystem, where the Asian companies will dominate. And frankly, if you want to play a global story, I agree, you shouldn't just restrict yourself to specific markets. You should have exposure to both.
And right now, I mean, speaking of all the geopolitical tension, right, and the volatility just, in the political space globally, do you think then it is especially wise to geographically diversify your portfolio, right? I know you said, we don't look at where the companies are first, we look at the company itself, but is this also something that investors can consider?
Absolutely. I think in today's market, we have a saying, diversification is probably the only free lunch that we have.
Wow,
because
okay.
that's the only way you can mitigate risk. We don't know what's going to happen in the world. But one way you can diversify, and we encourage most of our investors, including my personal portfolio, I try to have US. There's no getting away from the US.
Yes.
It's so large. Also have Asia, but also within sectors, you diversify. And if you're buying individual stocks, definitely spread your bets. Don't just have 50% of your portfolio in Apple. I know Apple is a great company, but I wouldn't put 50% of my portfolio in any stock.
Okay, yeah, that's really good advice as well, I think. So we have definitely touched on why tech is still attractive, right? And in the long time, would you say that the tech sector is still promising? Besides the AI wave, which I think now we kind of see that's not really just a trend, right? I mean, it kind of seems to be here to stay. But are there other kind of driving trends that will cause tech to be here to stay?
Okay, so for me, I think the innovation and adoption of tech is only going to get bigger and bigger and bigger.
Right.
Tech, in many ways, has become a necessity for all of us, right? If you see how we used to do banking, how we used to do transportation, order our meals, everything is dependent on tech today, right? Now, will the journey be smooth from an investment standpoint? Of course not. There's going to be ups and downs. Will the same set of companies, the Mag 7, exist 10, 15, 20 years down the line? I don't know. Some will. Some may get disrupted. We have seen this, like when I started university, the first mobile phone I had was an Ericsson.
Oh, okay, yeah.
I don't know if your viewers have used Ericsson,
Yeah.
but Ericsson and Nokia were the two largest players, and they were going to revolutionize the world. Then came smartphones, and today it is dominated by Samsung and Apple. Same thing, AI is one of those generational shifts that we're going to see. It will lead to disruption in technology as well. There will be new businesses that come up, OpenAI, Anthropic. I don't know how it'll look, but 100% it's going to have an impact. And so having exposure to tech makes sense, but I can't tell you for certainty whether the same set of companies will be there 10 years down the line.
Okay.
Just to add on to that, I think even tech as an investment is not the entirely right way, because every other industry would have some tech element to it. So, you, for example, take a name of JP Morgan. It's categorized as financials. It's a bank.
Yeah.
But they are one of the biggest banks that adopt AI. In fact, DBS is a financials, and they have a big AI wave, and there is a tech element to it, even if the investment category is financial.
Agreed.
So it's almost not very helpful to say I want to invest in tech, because actually, if I'm going to invest in DBS Bank, JP Morgan Bank, and even healthcare companies, Eli Lilly and Novo Nordisk, all of them are adopting AI in their own industry verticals. That is almost inevitable. Then the ultimate question then is, do I want to have a sectorial allocation, or do I want to stick to actually researching the companies, be sector agnostic, but really understand how an industry is adopting tech, or not even adopting tech for the sake of tech, but using tech to strengthen their moat? And you wouldn't be so conscious to say, I'm investing in the tech sector. You're just investing in companies that are innovating themselves, staying relevant as well.
Yeah, I think healthcare is a great point you bring up, right? Because we talk about aging society and all that and increasing demand for healthcare. And that's definitely never something that's going to go away.
Exactly.
And I mean, medtech, right? So many healthcare companies, including AI now in their proposition. So yeah, that's a really good point. I think we've talked a lot about young investors, right? And how they can build their portfolio with having tech, but not solely around tech. So, I mean, say like if somebody's 25, I only have $500 a month to invest, maybe even less than that. How then can I pick stocks, or what sort of instruments can I use to ensure that my portfolio is still diversified but also has exposure to tech, since it's such an exciting sector?
Yeah, so for me, I would say if you have $500 a month, you should allocate that $500 every month either into a ETF or a fund, or in DBS, we also have ready-made portfolios through Digi Portfolio that you can pick, and you can choose your risk profile. You can be more aggressive or you can be less aggressive depending on your tolerance. So, but the main thing is don't just go lump sum. Try to build it up over time and build up that nest egg, because that is the right way, in my opinion, to invest for youngsters. I wish I had started investing much earlier. In hindsight. So to your viewers, I would say, start early.
Okay, yeah, I think just now you mentioned dollar cost averaging as well, right? Which is exactly what Subhra's talking about. Maybe you can explain a bit what dollar cost averaging is.
Yeah, so dollar cost averaging simply means that you don't invest a big amount. Let's use a worked numerical example. If I have $10,000, I don't invest all $10,000 today. I kind of do a systematic plan to invest $500 every month until I've invested all 10,000. So maybe you invest the full 10,000 over the next 3 years. So that's an example of dollar cost averaging, because every time you put your tranche of $500, you would have either a different price point. Sometimes it's even better for you if the market is going down and you're doing this, so you're entering at a cheaper price. So that's the idea of dollar cost averaging. So I think I really echo what Subhra has said, that really with $500 you can start investing, and you can do that through DBS. You can even do it with us. Recently, StashAway launched a regular investing campaign to exactly encourage this behavior. So if you start a regular investing plan, you'll get some promotions and rebates as well. So we want to encourage such behavior. The beauty of doing that is you're not only building a diversified portfolio through exposure, but you're diversifying through time, right? You're not betting all in one price, which can work both ways. If from that price onwards it goes one direction, it's better to invest lump sum, but that's not a certainty. So it gives investors an easier way to have a more structured way of at least gaining exposure.
And it also takes away emotion.
Yeah. Yes, I was going to ask, how do you have that discipline, right? To really put in 500 every month. What if this month there's a crash and I'm like, I'm so scared
that's
now.
the beauty of it, because
Correct, yes.
if you're doing it through a systematic plan, it takes the emotion out of it. If you put a lump sum, what will happen is if there's a crash, it's human nature. You will tend to sell.
Yes.
And then when the market rebounds, you will try to get back in.
Yeah.
Through a systematic plan, you're actually investing irrespective of market cycle, because you're taking the view that over the long run, economy will go, earnings will grow, and therefore share prices will grow.
Right. Okay. Yeah, that's a great way of putting it as well. And I think we've discussed, you mentioned DG portfolios, or we used to call it robo-advisors or robo-portfolios, right? Yeah. So that's when a portfolio is curated for the investor, so they do not have to, for example, stay up to date with every individual stock. Okay. And about ETFs, maybe we can explain a bit about how ETFs work as well.
Yeah, ETFs basically track an index. So S&P 500 has 500 stocks, and ETF just tracks and mimics the index. It's a low-cost way of getting involved in markets. Actually, ETF, when I started in my career, ETFs used to be about 20-30% of the index. Today, it's over half of the US market is ETF. So the way of investing, and it's made it more accessible for people from all over the world to invest. So I would suggest just doing it through ETF. It's low cost. It gives you access to a broad index. It gives you access to all the companies that you talk about. And it's naturally diversified because it's tracking an index.
Wow, thanks for that. I think we've had a really good, a rich discussion on tech investments. And I think most importantly, right, we are saying don't go 100% into Apple, don't just go 100% into like a huge tech or AI company. It's about diversification, seeing your risk appetite, right, how much you're willing to stomach, and also to be disciplined in your investments.
I would like to just add to diversification as a concept, even though today we are discussing AI. And I want to try and contextualize diversification in the context of AI, because sometimes a lot of clients ask, what do we exactly mean by diversification?
Right, yeah.
There are a few forms of diversification. The first diversification is stocks, right? As Subhra mentioned, not 100% in Apple, you invest in a few companies. But that's a kind of a company level diversification. The second is also more of a theme diversification, because even if you're investing in NVIDIA, TSMC, SK Hynix, they're different companies, but they're all semiconductors. So that's some level of diversification, but not exactly, right? So even if investors want to invest in AI, how do you get a diversified AI exposure? Is, as Subhra alluded to, across the 3 layers of AI. You don't just want to invest in the hardware, the semiconductors. You want to invest in a mix of cloud software companies, hardware companies, and companies attempting to adopt AI. So that's another level of diversification where you're not getting a common risk factor. You're not getting a common theme where if semiconductor as a whole suffers, your diversification is an illusion. So, and the third level of diversification is, okay, beyond AI, AI should sit along other sort of core asset classes. One more diversification is time, as I alluded to. So these are the 4 kinds of diversification that at which it's not the most sexiest concept, but it gives investors the comfort to gain exposure to important themes and not have to worry about, is this the most expensive time? And it's aligned to my own financial goals, even if there are volatility. So I just want to leave with your audience that, diversification in AI has also a kind of different meaning, a closer life to it as well.
Yeah, I think that's super important, right? I mean, the fact that it is a more complex issue is not just about, I see what people on Reddit are saying about this stock that's very exciting today and I buy into it, but it's about really systematically building a portfolio, right, that's able to withstand whatever market crash or whatever bubble that you think might come. Okay, that's a wrap for this episode of Head Start on Record. Thank you, Subhra.
Thank you very much.
And thank you, Mark.
Yeah, thank you for having me.
I'm Su and Tan. You can email us your thoughts on this issue or suggest another topic you'd like us to tackle on the show. You can also reach out to me on LinkedIn. And if you'd like to read my articles and ST's Head Start newsletter, all these links are in our podcast show notes. This episode is edited by Amirul Karim. Thanks for listening.